Hey everybody, thanks for joining me today. My name is Kelsch. I'm one of the wealth strategists here at Paradigm Live. And today I'm going to talk about the stock market and more specifically the average returns, the average projected returns versus the actual market returns. So a little bit about the stock market. First of all, it is referred to as a savings vehicle, a retirement savings vehicle, and in fact is one of the primary savings vehicles in use today. Well, there's a problem with that, and I mean there are many problems with that, but one problem is fundamentally with the idea that the stock market is a savings vehicle at all. It is an investment. It is not a savings. So what do I mean by that? Well, investments have the ability to have value evaporate out of them. So the stock market, obviously, with the volatility, with the fluctuations, there can be a tremendous amount of value of the asset just evaporate. And an example of that, personally, I had a 401k in 2008, invested in the stock market, and 2000, it was established, and in 2008 took a serious hit on that, on the balance of that 401k, and it was due to stock market volatility. So personally, I went looking for a different quote-unquote savings vehicle where I had a lot more control and a lot less risk. So I've got a question here. If what you thought to be true turned out not to be true, when would you want to find out? So what I discovered when I looked into the stock market and how it truly works is there's a dirty little secret called average versus actual, and not very many so-called stock market investors understand that. Meaning the Joe public, they don't really understand average versus actual because it's not explained. It's kind of it's disguised, if you will. We're gonna flush that out today. So first of all, I want to talk about what it would look like, what an average return looks like, and how it compares to an actual return, or what actually happens in the market. So I'm gonna put here on our axis here, this being dollars and this being time. Based on a graph like this, and based on averages, average is more of a point-to-point return. So it's saying whatever happens, whatever fluctuations are happening, we're going to take the average of those fluctuations, and that's how we determine our rate of return. Whatever that our rate of return. Let's say it's 8% or 9%, whatever the case may be. Okay, it's assuming that whatever happened in here, whatever happened in the stock market, we add all those things up. We add all the high points up, and we add all the low points up, and we divide it by the number of periods there are, and that's how we get our average. Well, that sounds good, and it looks really good on paper and on the annual reports that we get, but that isn't necessarily the truth. And anybody who lived through 2008 and had any money in the stock market can probably attest to the fact that money does in fact go from a high point to a low point when there is when there's market volatility. So let's take a look at this in a calculator I've got here, and see exactly how this works and the differences. I'm I'm going to get a clean sheet here so we don't have background distractions. So I've got a 4-year period here, and I'm going to say in the first year here we've got now we're getting an average here. In the first year we've got 100% rate of return. In the second year we have a minus 50% rate of return. In the third year we have a 100% rate of return, and in the fourth year here we've got a minus 50% rate of return. Well, down here you can see that gives us a 25% rate of return. In fact, if I show you the averages here, average rate of return is 25%. Now what happens, and this is how the stock market is referred to typically on a statement. You know, you've got your beginning balance, you've got your average rate of return, and then you've got your ending balance, and your contributions usually in the middle here. And typically speaking, an individual looks at their beginning balance and says, oh, I had X amount in here, and my financial advisor is telling me I made X return, and my end balance is higher than my beginning balance. Oh yeah, and I did put a little bit of money in there throughout the year. But the fact that my end balance is higher than my beginning balance, and my financial advisor says I'm making X return, I'm good to go. I'm good to go. So, and they put it in the drawer and don't think about it again. Well, right here we can see there's an average rate of return of 25%. But if we put some money in here, let's just use $10,000. We're going to be using that kind of throughout here. So I'm going to use $10,000 in this as a present value. I have $10,000, and if we look at 100% rate of return, well, there's our earnings, and now we have an end of year value of $20,000. So we have the beginning year of $20,000. We have a 50% loss. We are back down to $10,000. Next year we start with $10,000. We have a 100% rate of return. Well, we're back up to $20,000, and then that second year the fourth year here we've got a 50% loss. So we're back down to $10,000. So you can see right here, average rate of return is 25% based on the earnings rate, adding these up and dividing them by 4. The actual rate of return is 0. And that's because we start with 10,000 here and we end with 10,000 there. So there is zero movement on that money. It gets even worse when, I'm going to take this, I'm going to delete that out. It gets even worse when we actually contribute on an annual basis with this kind of average return. You can see here our actual return contributing $10,000 a year over this 4-year period with this same 25% average annual rate. It gives us an actual negative 11.18% rate of return, and that's because we start with, we contribute the 10,000, we have earnings of 10,000, we come over here with 20,000, we start with 20,000, add another 10,000, have a 50% loss. Now we're down to 15,000. So we have over here 15,000. We add another 10,000, have a 100% rate of return. That gives us 50,000. And then 50,000 here, 50% loss, the addition of another 10,000, the loss of 50%, we're down to 30,000. So now we've contributed 40,000 throughout that time frame, and we have an ending balance of 30,000. Okay, so let me do this here. So now I'm going to take a look at the market returns. I'm just going to go back 30 years. So that's 1986 to 2015. Average rate of return in the market was 9.27%. So right here we've got our calculator here with a 9.27%. You can see here that is the average rate of return. And so I haven't changed anything in here, so it shows that as an actual rate of return. Now what we've got here down at the bottom, you can see here is about $1.5 million, 1566542. However, that is not the full story. That's just the average. So I'm going to take this. I'm going to copy here, copy this, and paste it here. First, let me get I'm going to paste values here. So you can see here what happens when we put in that stock market return with the $10,000 contribution over that 30-year period. We still have an average rate of return of 9.27%, but our actual rate of return drops down to 6.94%. So we went from about 1.5 million down to about 1 million there. So let's take a look on. We'll just kind of look and see what some differences are there. So if we have let me look here. If we've got $10,000, and we have an average rate of return of 9.72 over 30-year period here. There it is, the 1.56. Okay. Take this other one here, $10,000. Actual rate of return of 6.94% over the same 30-year period. There's our 99 and some change here. So question is, well, a lot of people assume that they are making this type of return on the stock market. Again, this is based on the averages. I just pulled this off of a market history. But if I'm expecting to have 1.566542 in retirement based on $10,000 a year over a 30-year period and an average rate of return of 9.27, and I end up with 999,324, that's a difference. That's a difference of 36%, or a reduction in value of 36%. Well, that's pretty close to 33%, which is a third of the total value. So what that tells me is, if I was going to live on $1.5 million, or that's what I anticipated receiving or having by the end of that time frame, and I only end up with $1 million, pretty close to there, I'm going to have to reduce my standard of living by a full third, and that's a tremendous amount of money. And let me show it one more way here. Show this on a graph. I've got a pretty good visual we can use here. So here's the market returns. Let me get rid of this for a minute. Here's the market returns. All those numbers put in here, and we've got our 9.27 here. So on a graph, you can see there's a tremendous difference. There's our $1.5 million compounded at 9.27% that we're expecting, and here's our about $1 million. So huge difference. But this is actual market returns, and this is what's projected. So we can see there's a huge difference. Now, is that the end of the story? Well, no, it isn't, unfortunately, because who else is involved when we have money in the market? Okay, bankers, these huge banking institutions that run the stock market, and of course, every time you make a trade, someone gets paid. So I'm going to put a conservative management fee in here. I say conservative because, depending on whether you're managing it yourself or you're putting it into a qualified plans and things like that, I'm just kind of taking an average there. So what happens when we have those fees come out every year? It reduces our actual rate of return even that much more, and that's because these management fees are being taken off of the balance, off the ending balance. So even in the down years, you can see here you've got a lot of up years. A lot of really nice up years, 27%, 26, 34, 31. But in the down years, even though you're losing money, well, they're still making money. They're still going to get paid here. Somebody else comes to call as well in most market funds, and that is our big brother, Uncle Sam. So I'm going to put, again, just kind of a generalized, not 0.20, it's actually 20%, not 0.20%. That would be nice. Anyway, 20% tax bracket. Again, just kind of taking some averages there. And so we've got our taxes coming out here. Look what that does to our actual rate of return. It brings it down to 3.29%. So, and now we've got an ending balance down here of 5.15. Excuse me, not 5.15, 515,000 rather than the 1.5 million that we were anticipating. So now if I plug that number in, we got 515,155. Well, that's a 67% reduction below what we anticipated we were going to end up with. So then the question comes in. I mean, well, it's not really a question. It's no wonder, based on this information, why so many Americans are reaching retirement age and having to continue to work. So the question begs here, well, who are the real benefactors? And I would say to that, you would have to follow the money. Well, the government is guaranteed to get their money, and the banks are guaranteed to get their money. So who are the real benefactors? And then if we wanted to keep going further with that, we add inflation to that, but it'll makes the numbers even that much worse. But that has to do with purchasing power. Anyway, I ask again, if what you thought to be true turned out not to be true, when would you want to find out? And so I would say the earlier the better. Anyway, thanks for watching. Again, my name is Noah Kelsch. I'm with Paradigm Life, and feel free to reach out to us or visit our website www.paradigmlife.net. And thanks again for watching.